it is fascinating to see there's so much more demand now for silver, and I think we're going to see in the future, I think physical demand is going to finally overwhelm the paper price. We're having about the same amount of demand, even though it's falling a little bit in industry, but the United States and India are absorbing, consuming so much more silver, and there's reasons for that. I think the United States is consuming more silver because of investment. India, it's investment, but they're stockpiling now for their huge solar projections of increasing installations until 2022.
It's been 115 years since investors had an opportunity like this. The energy of the future. Now Elon Musk and Frank Giustra are betting big on the rise of this energy source that will change the world. We are talking about the oil of the 21st century. Learn more at crushthestreet.com/charge.
Hello, everyone, and welcome into crushthestreet.com. We got a returning guest today, Crush the Street favorite. His name is Steve St. Angelo of SRSRoccoReport.com. Steve, thanks so much for taking the time to come on the show with me today.
Yeah, Ken, it's always a pleasure. Looking forward to talking.
Steve, I didn't give you much of an intro there because, honestly, you have become such a legend in the alternative media space, and, people just know you for your just impeccable research on the precious metals market, energy markets, the indices, and you are so articulate in the things that you have been able to share with us. So I'm looking forward to this conversation. I want to start off with oil, and we've talked about it numerous times, and how the economic engine, the society needs higher oil prices, but we can't afford to see higher oil prices. And today we have oil prices that have come up from their $20 range lows that we saw. But what's interesting is we've seen the stock market rise with oil prices. Is it fair to say the stock market is liking these higher oil prices here?
Yeah, I think the whole thing kind of, the same thing took place in a run-up to 2007. I mean, gosh, we haven't surpassed that high of $145 for Brent back in 2008. We haven't surpassed it, even though we've had high oil prices, sustained oil prices of 100, 110 from 2012 or 2011 to 2013. We never got above that 145 level, but everything went up together, and then everything fell together, and it's been differently this time around since 2013. The metals sold off first, and then oil finally sold off in the end of 2013, starting in 2014. But I think yes, it kind of runs together. But what is interesting about oil, and they called it a short covering rally, and it was. I guess a lot of the speculators thought we would see continued lower oil prices, and I think we are. But they really got overzealous. They came in a big way, and there's a huge amount of shorts there at the price of 27, 28. And so the price of oil then skyrocketed up over the past 3-4 weeks. Well, what is really interesting that no one has talked about, I'm not quite sure if the banks had anything to do with it or partially responsible for this huge short covering rally and this almost $15 move in the price of oil. But what they did do is a lot of the companies, a lot of the shale companies and the oil companies, they issued more stock at a higher price. And then when they got that revenue, they got to pay back some of the debts to the banks. See, that's not being mentioned much in the media, but that's kind of a positive thing for the banks getting the price of oil up to, let's say, $40. These shale companies were able to liquidate some of the debt that they owed to the banks, so the banks are in less of a horrible situation than they were, let's say, a month or so ago.
So do you think that's where the rise in stocks came from then? Is the oil companies being able to pay some of their debts then?
You know, I think the fundamentals of the markets, if you just look around and you see that China's exports fell 25% in February. Now, part of that is due to their Lunar New Year. Part of that, but even if you adjust that out, it was much worse than they forecasted. So, if you consider that China's exports are falling that much, well, everything is really starting to get hammered in the real economy. So it doesn't really denote to have higher stock prices in March, at the end of February and March. So I think this has to do with either another dead cat bounce or the Fed and central banks coming in and propping up the markets and basically getting investors flowing back in, because I also think it was a short covering rally too for the S&P and the Dow Jones. So I do think it's similar to oil.
Steve, in 2015, we saw oil fall to about $40 and then come up to about the $60 range. And this is very reminiscent of that time here, you know, falling to $26 and now back up to $40. And you're talking about oil going below where we've seen it go in the most recent low here. So you're talking about basically a 50% crash in oil from where it is now. So is this fair to say that you think it's going to go down another 50% from where it is?
Trying to forecast the price of oil is a fool's game. But when you look at the fundamentals, and the fundamentals are, even though the Middle East is talking about doing these oil production freezes, it doesn't mean anything. Iran's going to continue to increase production because they can. Now, a lot of these other countries, like in the Middle East, like Saudi Arabia, they need $100 oil to balance their budget. So because they're getting 40, they have to sell U.S. Treasuries now to supplement the losses they're not getting from the revenue losses, to supplement their national economy. So I think the problem is, even though U.S. oil production has declined from its peak last year of 9.6 million, it's about 9 million barrels now. I think that will decline even at a higher rate over the next 8 months. But I still think the economy is going to continue to kind of implode. It's going to continue to kind of disintegrate. So I think demand is going to fall, even though the prices are cheaper, to go in a car and drive around all over the place. But I still think demand is going to fall faster than the supply does. And so I think what's going to happen is I think we're going to see a lower low of oil. And let me tell you, Chevron just announced an unexpected loss of $500 million in the last quarter of 2015. Now, that was when the price of oil in the United States was $46 in October, $42 in November, and $37 in December. So you average that, it's probably about $42. Well, January and February, it was $31.
Yeah.
It's even less than what it was in the last quarter, when Chevron had one of the worst losses in a long time. And so this quarter is going to be even worse. Now, in March, the price went up to 40, but I think we're going to see the price continue to fall. I don't know how far it's going to fall, but the fundamentals of, we have way too much stock still in the United States. I'm not saying globally, but in the United States, we have way too much oil stock. So I don't see the price rallying like to $50 or $60 anytime soon, unless there is a black swan in the Middle East.
Yeah. Steve, a lot of people are forgetting about January and what we saw with the markets, and there was a lot more concern for this. So I'm glad that we're able to talk to someone who is able to talk some sense into these, perceivable stable markets, perceived stable markets, because people are forgetting about what was happening around that time and what we can continue to see going forward. So you recently wrote an article, Dow Jones versus Silver, Trading Volume Says It All, and you've pointed out that the Dow Jones is being propped up by declining number of market participants. Now, it would appear that HFTs and mystery buyers are working overtime here, Steve. Your thoughts on this?
Yeah, I had one comment on that article. They said that, well, Steve, you have to understand that the lower overall volume of the Dow Jones, according to my analysis, looking at 2009, the Dow Jones was trading over 5 billion shares a day. It's now trading about 2.1, so it's in half. Its daily volume is almost in half. Well, that's not indicative of a healthy stock or index or commodity. Normally, when we see a healthy increase of a stock price, the volume moves up in parallel. But he said, well, there's a lot of share buybacks. So the share buybacks there's less shares now outstanding. Well, if you look if you go to my site and look at this article, which is the Dow Jones versus Silver Trading Volume Says It All, the Dow Jones actually volume increased from 2002 to 2008 during the Dow Jones index move up. It increased, but there was share buybacks. There was record share buybacks in 2004 and 5 and 6 and 7. They're doing the same insanity back then as they're doing now. So they may be doing it to a larger degree this time around, but I don't think it accounts for the huge decline in the volume. So I think there are less and less participants. I do believe now it's a lot of this. I think the central banks are buying the indices. They're buying the triple Qs or whatever, and they're trying to prop the market up on less. It's like going higher on less volume, and that is the disaster waiting to happen. And if you look at the silver chart, we're seeing the exact opposite. The silver chart since 2002, even though it had these spikes down, it is higher. It was $5 in 2002. It's now 15, but the volume is almost double. So I think silver is set up for a much better, healthy move forward than the index, the Dow Jones.
I mean, your analysis is just showing the inevitability of both of those going in the inverse direction. Talking about silver going higher and the Dow Jones going lower. So, if you could just continue on silver here. I mean, you've done a lot of research here. You got Silver Eagles and, what India is doing. I mean, what are your thoughts with silver here going forward, Steve?
Well, in my most recent article, which is record-breaking silver factors in 2015 can make 2016 quite interesting, you're correct. There is a chart that I put together, and what I like to do is sometimes figures are manipulated, but the trends can't be. Overall trends are hard to manipulate over a long period of time. And if they are manipulated, you could see how they are. If you look at this chart, the first chart, it's U.S. and India silver imports versus mine supply. Both the United States and India imported roughly about 7,250 metric tons in 2012. That's what they imported. Well, that was about 29% of mine supply. Well, this moved up in 2014, but in 2015, it's a record. U.S. and Indian silver imports are now like almost 14,500 tons. That turns out to be 53% of total mine supply. And so what's happening is we're having about the same amount of demand, even though it's falling a little bit in industry. But the United States and India are absorbing, consuming so much more silver, and there's reasons for that. I think the United States is consuming more silver because of investment. India, it's investment, but they are stockpiling now for their huge massive solar projections of increasing installations until 2022. So it is fascinating to see there's so much more demand now for silver, and I think we're going to see in the future, I think physical demand is going to finally overwhelm the paper price.
So in that vein, Steve, talking about what India is doing with solar energy, we've had this discussion in the past talking about solar energy viability and how really it's not profitable and it's not economical for these energy companies, these solar energy companies, to be in business. And there's reasons for this. So, Steve, would you mind going over with us and exposing these solar energy companies and kind of how they're even able to stay afloat?
Okay, I'm going to explain how I look at the larger installations, and then how it differs from a, let's say, local, simple, small installation on a house for someone to have guaranteed power. Those are two different things. If we look at the solar industry, even wind power, wind turbines, when you look at their cost of production, their maintenance, and the electricity that they generate over their lifespan, and of course, solar loses efficiency over time, and it starts to pick up, especially after 10 years. The efficiency, you start losing efficiency. Well, when you do a cash flow analysis, and I came across this one engineer who was doing it in his own state. He's a mechanical engineer, and he saw all these new wind and solar projects going up around his state. So he started doing cash flow analysis. And when you base it upon no subsidies, that means the project isn't funded by the government or someone. That all the capital has to come from, let's say, a private person or a group. And then they get the typical wholesale rate of electricity. That's depending on what area of the country you live in. If you put those two parameters, and let's say $10 million was invested into the plant, by the time 25 years that plant had been into production, you wouldn't even get back your $10 million. You just won't get it back.
Wow.
Now, how does that make sense? Why are they doing it, and how are they making it feasible? There are subsidies. The government is paying grants. A lot of these companies are getting funds to build part of the construction. And then once they start producing power, utilities, they have these agreements, and the government is pushing this, that the utility pays the solar array or the wind farm sometimes 2 to 3 times the wholesale rate. So that's the only way these things make sense. Now, one of the people I follow is Charles Hall. He's since retired, but he's been one of the head researchers on the study of the energy return on investment. And he has shown that when you look at all full cycle costs of wind and especially solar, and he used Spain's solar industry, which they really ramped up in the last decade, it was a disaster. And according to this one article that was written last year in September, at the time, 44,000 of the nation's 57,000 PV installations in Spain were bankrupt or near bankrupt. And so the problem is, solar on a huge scale doesn't pay for itself. It's like corn ethanol. You almost put more energy in producing corn ethanol than you get out from making ethanol from it. And so solar is actually worse than that. You don't even get your return back.
So
go ahead. I'm sorry,
Steve. When it comes to traditional electricity, where they typically get it from, and paying, Edison or some of these other local solar companies, are people paying more for traditional than they should be? In California, for instance, it makes sense, from just looking at the numbers, if you have a big house, that you would pay for solar, because over the course of 20 years, if your bill's $500 a month for traditional and only $150 a month for solar, it ends up working itself out with the numbers. But what is the issue with people overpaying for the utilities? Why are people overpaying for the traditional conventional utilities?
Well, it's probably for various reasons. Normally, natural gas and coal have been the cheapest, and they continue to be the cheapest. I'm not against, for the environment, cutting down coal. I'm not against it at all. And I'm not saying solar is a bad deal. They say it's clean, but when you factor in all the processes, the whole full-scale processes of solar, it's not really much cleaner than the, let's say, the fossil fuel electricity generated power. But the issue is this. Solar, it's more expensive. And they say technology is dropping the cost of the panels. Well, that may be true, but the cost for installation, the cost for all the other things really don't come down. They stay about the same. And then you have to maintain these solar arrays. These huge solar arrays have to be cleaned. There's a lot of upkeep on them, a lot of maintenance. And so the problem is, Kenneth, that in order, once the sun goes down, so does solar electric generation. And here is the issue that's not spoken about. Solar's great to have on your home if you got a very small unit, a very small system, some batteries, so you can power a few things, just like computer, maybe TV. Not you won't be able to really do your refrigerator unless you get an efficient refrigerator. But a simple system to have a power for certain things, that's a good thing, even if you don't get your money back. However, when the sun goes down, there is a huge drop of power going into the grid from all these solar arrays, especially in California. So what has to happen, there's this very expensive balancing power that must come on because people have lights on at night. And so there's this natural gas, they call them natural gas generating balancing power systems. And so the more solar you put on the grid, the more balancing power you have to have at night, because they really haven't come up with a feasible economic way of storing this solar power. So it all comes in during the day when the sun is blaring, and then it shuts off at night. And then you have to bring on this balancing power, which is very expensive. So when you add very expensive balancing power on top of expensive solar power, it's rising the cost of electric rates, especially in California and across the world. And one more thing, people who think that they put solar on their house, and they spend a lot of money doing it, that's fine. And then they get, actually the solar is connected to the grid, and the electric company or utility now pays the customer, the homeowner, for their power generation. They are now charging in several states almost $20 to $50 a month for that solar connection.
Wow.
And so a lot of these people are upset. The problem is, and I think I may have mentioned this before in a previous interview, those people are not paying to maintain the grid. And every little bit of more power that's generated by solar on someone's rooftop is less power that the company gets as a real revenue. So who's going to take care of maintaining the huge grid? The electric companies are, the utility companies are, but they have to get profitable revenues. So there's always two sides of the story. And again, the only way I see solar as viable, Kenneth, is if you have a small system on your home that's standalone with an inverter and some batteries, so you have guaranteed power when the grid goes down, and you don't care about getting your money back.
You know, it almost sounds like a very prudent thing to have what you're talking about, because, in the event of a major market shift, a collapse, a disruption in our system, it's very good to have that self-reliance. Steve, let's talk about this. What else are you doing to be prepared for what you expect happening in the economy?
Well, my wife and I, we sold our business in 2007 and moved to the country. I knew the system was going to crash. I knew it. What I didn't know is the amount of leverage and the financial propping up that the central banks, the Fed and central banks could do. I just did, and most precious metal analysts were caught by surprise. They didn't realize it either. So with all this extra money that was thrown into the market, especially zero interest rates, it allowed this very expensive, crappy shale oil and tar sands to come on. So what it has done, it has given us, let's say, a 7, maybe a 10-year reprieve. It bought us 7 to 10 years, but I think the collapse will be even worse. So what we do out here is we have our own organic garden. We've got goats and chickens. We live more simple, and we don't have any debts. There's no guarantee in life how things are going to unfold, but I'd rather be growing my own food in the country than living in a suburb and having to buy, produce from the supermarket. That a lot of it is commercial. So the thing is, there is no guarantees. I do believe the smart thing for investors or individuals is to have these basics first. It would not be wise to be in a 20-story condo in New York or Miami with a whole bunch of precious metals. I don't. If there's a crash and a collapse, I don't think that's a wise place to be. So I think covering your basics is understanding how to grow food, is to be kind of away from the big cities if you can, or know people who are, family and friends, and then precious metals are a good place to store your wealth. We may not have a real bad case scenario going forward. I think it will be, because of what I've talked to you before about our declining oil production will just get worse going forward. And so we're just going to have to, it's going to be more local and regional living kind of systems, not global. Globalism is going to disappear.
You know what you're talking about, Steve, you've been able to become independent from, what we have all become so dependent on, which is technology and the system, society. I mean, I live outside of LA in a suburban city. And I just think about, even if we had like a solar flare, and let's say I'm 30 miles, in the city, I'm in LA, and, the car does not work, the refrigerators around the city, even like an EMP could do this. Refrigerators around the city are now going out, so food is going to be going bad, and my cell phone doesn't work, and we all got to get home. I mean, that's a situation where I'm completely just within the system, the collapsing system, and I'm very vulnerable in that case. And it really bothers me, these things, the risk of the markets, the risk of a collapse, that I am still within 30 minutes of downtown LA, and the risk that poses to me and my family. So I definitely do what I can, with food storage, weapons, prudence, debt, all these things, but I definitely feel exposed being in a very crowded area. So, Steve, any last thoughts before we say goodbye here? It's been a great interview so far, and I appreciate you for coming on. So any concluding thoughts before we say goodbye?
One thing, and I get this comes up quite a bit in comments and emails. There's this incorrect assumption that technology is solving our problems. And I'm not saying technology hasn't offered us some nice things. Going to the dentist and getting a root canal, or getting excellent doctors to do surgeries that we couldn't do 100 years ago. These are valid things to say technology has done. However, the problem is people can't. It's like The Matrix. There was the show, the movie The Matrix. There was a scene where they were looking at the screen, and the guy it basically is a bunch of code coming up and down the screen. That's all it was code. And he says, well, if you look at the code long enough, you don't see the code anymore, you see the picture. Well, that's the matrix. The matrix is people don't see the cost of technology because they look at a farmer out on in Iowa with a huge combine, and it's like, look how efficient that one farmer is. He's got this huge tractor and this huge combine, and he's actually producing all this food for thousands of people. Well, you see, the energy return on invested of modern agriculture is 1 to 10. It's a huge net energy loser. For every 10 calories of energy that goes into producing the food, you get 1 calorie of food out of it. That's a huge loser. Now, if I went out to my garden and just used regular hand tools, I'm getting an energy return on invested of about 5 to 1. It's a 5 gain. So the reason people don't understand that technology isn't solving our problems, it's making things worse, is because they're not able to look at the whole system, all the energy costs, all the way down the line. And I just want to end this interview by making people who still don't get it, and I hear it all the time, oh, I don't worry about the future because technology is going to figure it out. Technology has been making it worse because it's like a drug. We need another technology to fix the problems the past technologies have been creating. And then you need one more that's even worse, but it looks like it's more efficient. And huge tractor combines are not more efficient. They're more destructive, and they're more energy consuming. So I want your listeners and readers to understand that going forward, the falling energy return on invested of our energy supplies, oil, natural gas, is putting a huge pinch on the system. And the best thing to do is to become more self-sufficient as best you can and invest in the precious metals. Those are the 2 best advice I can give to your readers.
Wow, Steve. Well, everyone, that is Steve St. Angelo of the SRSRoccoReport.com. Visit the website. A lot of great information. If you like this interview, visit his site, and there's just that and so much more. So, Steve, thanks so much for coming on the show with me today.
Kenneth, thanks a lot. I did want to mention I'm putting out these new bullet reports. One will be out, I think, next week, and I'm writing about the gold flows in the market, investment flows in the market, how it's impacting the price. And I think it's these flows that have been taking place over several decades, and especially recently, I think it's going to be indicative of a big movement in the gold price in the future. So I will be putting that report out possibly next week. So I just want to let your readers and listeners to know about that.
Absolutely. Be sure to check it out. Steve, thank you so much.
Thank you, Kenneth.